is joining us from Elara to talk about all those factors and more. Shiv, good afternoon. Thank you so much for your time. Let's start by understanding your thoughts on the valuations of the market. Irrespective of the trigger, we did go through a reasonable bout of correction. How are valuations looking to you now?
Hi, good afternoon, and thanks for having me here. Uh, I think from a valuation perspective, clearly the market has become much more attractive compared to, let's say, a month ago, or let's say where we ended the last year, 2021. And clearly, we believe that there are pockets of value which is emerging in the market at this point of time.
Okay, so let's elaborate a little more about those pockets of value. What kind of discussions are you having with your clients about those? Is there eagerness to buy?
So, of course, I think there is a lot of positivity, as you can see, from the domestic mutual fund buying numbers that we can see every day. In terms of the specific pockets that we are seeing, clearly banking stands out as one of the great value proposition at this point of time. And what we look at is not just the value in isolation as a standalone number, but what we really like to look at is valuation given the growth prospects. And so typically what you will like to call it as growth at reasonable price or reasonable valuations. From that perspective, I think banks clearly stand out. It's been trading at let's say closer to 10-year average valuations. Either you look at from a price to book or a price to earnings, and the fact that you will see a rebound in credit growth, and the fact that the worst of the credit cycle is behind us. Clearly, we believe that banking is one of the more promising one. Other than that, of course, sector like pharma is something which had a pretty tumultuous 5 years, but probably the valuations are factoring in most of those pains, and even a little bit of a positivity around the US business can see some significant traction around that particular part as well.
Shiv, what kind of a earnings season do you expect for your universe of companies this quarter?
So I think this quarter will probably continue, the trend that we have been witnessing for the last couple of quarters, in the sense that you would see, sectors like, let's say, the banking will continue to do well, given the fact that, you will continue to see reduction in the credit costs. And again, the commodity heavy sectors like the metals and the energy sector, those should again continue to see buoyant earnings. Uh, Other than that, what we are expecting to see is a little bit of a rebound in the consumer discretionary from a volume perspective. But of course, they will continue to see a little bit of a pressure on margins. Uh, Given the current set of events, probably a little bit of a more would also take place in Q1 of next year. But I think the key point to sort of look at is going to be the recovery on the demand side, on the discretionary, and hence volumes are going to be far more important at this point of time rather than the margins per se.
Which sector, to your mind, or which companies or category of companies could stand out even in this quarter, in your view?
I think, one of the sectors that should stand out this quarter is going to be, all the segments which are related to the unlocked trade. We are seeing a significant buoyancy on, things like hotels, travel, tourism, movie exhibition businesses, retail. So I think that is one particular space which I think investors should look out for. And we believe that there is going to be significant positive surprises in that particular sector.
One were to expand the horizon beyond the quarter on a 2-year basis, what kind of names come to your mind which will see the most healthiest earnings growth, even if you look at 2 to 3 year kind of a view?
So when we look at 2 to 3 year perspective, I think technology as a sector clearly stands out because we believe that um, the underlying trends are very, very strong. And, globally, the, digital transformation that we are seeing, that is only going to get stronger as we go forward. The second, the energy transition related sectors, which is basically the renewables and, the hydrogen and the electric vehicle segment. I think, that space is going to see again a very strong tailwinds as we go forward. And the third is basically going to be the capital goods sector. Given the fact that we are looking at a strong government capex, which will be supplemented by private capex, which will be coming out of energy transition, which will be coming out of PLI, digitalization, things like that. So I think these three pockets will certainly see very strong earnings tailwind from a 2 to 3 year perspective. And some of the stocks that probably will stand to gain a lot. I think if you look at from a large cap perspective, companies like Reliance Industries, which have been taking significant steps on the new energy side. I mean, we have seen the string of acquisitions that they have done over last 6 to 8 months. I think clearly that's one company which is to be watched out for when it comes to the new energy side.
Right. Shiv, how is your portfolio construction model portfolio looking right now? You must be following one out of all the universe of companies which you track. There must be a model portfolio. Can you share what are the changes you've made there?
So basically, we have gone overweight on the consumer discretionary side, and some of the other sectors that we like are the metals and no, sorry, not the metals, but the financials uh, sector and the capital goods sector. So those will be the three most favored sectors for us from a portfolio perspective. And some of the sectors that we have gone underweight would be largely the commodity related sectors.
You believe that the best of commodity is behind it?
Yes, we think that some of the factors that sort of played out last year in 2021, which was the global recovery in growth, uh, a lot of supply constraints that you saw across the value chain. I think some of those factors should unwind. Of course, you will have curveballs like the current Ukraine crisis, but I think a lot of those issues are probably on the mend as we go forward in 2022. And hence, some of the inflationary pressures should start to come off. And, we should start to see, the consumer discretionary side, which suffered a lot because of, both, a very, very weak demand as well as a lot of input side pressure should start to see benefits on both the sides.
Before we let you go, your thoughts on the mid and small cap end of the market. Do you think that has become ripe for bargain hunting or not yet? And if yes, what kind of themes are you bullish on in mid caps?
So I think we have always sort of stayed away from painting the mid and small cap space with the same brush because we believe that the mid and small cap space is a lot more bottom up approach than looking at a overall space. Given the fact that probably if you look at every third or fourth company is going to be a different animal in itself. And hence we believe that it's always useful to look at the specific pockets and the specific stocks which will do well in the mid and small cap space. Having said that, from an investor perspective, still, if one wants to look at certain spaces, we believe that spaces like textiles, like chemicals, basically the spaces where you have a strong story around either import substitution, or you have a strong story around, exports gaining momentum because of, let's say, a China plus one kind of a policy. I think those are the segments that people should be looking out for.
Let you go. Just a quick word on the way Chinese markets have collapsed and flows have gone out, both FDI and FII. Triggers could be various. The government got quite strict on the edtech universe and all of that and scared a lot of FIIs away. Because you deal with a lot of FIIs yourself, do you think there is a case building that a large part of that money could look at other emerging markets, growth oriented like India, and we could turn out to be a beneficiary?
Yes, certainly. I think there is a case for it. But I think it's going to be a lot more gradual process rather than, a step function, given the fact that, of course, the Chinese market from an overall market cap perspective is much bigger than India. Uh, and also the fact that, some of the companies there are, they are the leaders in their own space in China. So I think, we do believe that, China as a market will derate gradually. I mean, we have already seen one round of derating in that particular market, and we would continue to see that derating probably taking place as we go forward. But we believe that, that process is going to be a lot slower than what we, would otherwise believe.
We'll let you go on that one. Thanks so much for joining us on the show with your thoughts.
Thank you so much.
Time for a short break. More news and updates and analysis on the other side. Don't go anywhere.